guys, welcome back to the channel. I'm Michael Studebaker, and today we're going to be talking about what is passive income and just my 5 ideas on how to help you retire. So if you haven't already, please subscribe. If you like the video, hit the notification bell if you want to see more content on personal finance. Now, let's get straight into it. So first off, we're going to be talking about what is passive income. So passive income includes regular earnings from a source other than an employer or a contractor. So the IRS says that passive income can only really come from 2 sources, which is rental properties and businesses in which one doesn't actively participate in. So such as being paid book royalties or stock dividends. Many people think that passive income is about getting something for nothing. It has a get-rich-quick appeal, but in reality, it still involves work. You just give the work up front usually. So in practice, you may do some or all of the work up front, but passive income often involves some additional labor along the way too. You may have to keep your product updated or your rental property well maintained in order to keep the passive income flowing. But if you're committed to the strategy, it can be a great way to generate income, and you'll create some financial security for yourself along the way. So first one is dividend stocks. So dividend stock shareholders in companies with dividend yielding stocks, they usually receive a payment at regular intervals from the company. Companies pay cash dividends usually on a quarterly basis out of their profits, and all you need to do is own the stock. Dividends are paid per share of stock, so the more shares you own, the higher payout. Since the income from the stocks isn't really related to any activity other than the initial financial investment, owning dividend yielding stocks can be one of the most passive forms of making money. The money will simply be deposited in your brokerage account. The risk here is choosing the right stocks. I do warn that too many beginners jump into the market without thoroughly researching the company that's issuing the stock. You've really got to do your research on each company's website. You got to be comfortable with their financial statements. You should spend a few days to a week investigating each company, in my opinion. That said, if you don't have time or you want to spend little time researching, there are ways to invest dividend yielding stocks without spending a huge amount of time evaluating each company. I suggest going with an exchange traded fund or ETF. ETFs are investment funds that they hold assets such as stocks, commodities, and bonds, but they trade like stocks. ETFs are an ideal choice for beginners because they're just easy to understand, highly liquid, inexpensive, and have far better potential returns because of far lower costs than mutual funds. But another risk is that stocks and ETFs can move down significantly in short periods of time, especially during times of uncertainty, like in 2020 when the coronavirus crisis shocked the financial market. Economic stress can also cause some companies to cut their dividends entirely, while diversified funds, usually like ETFs, may feel less of a pinch. But if you choose dividend aristocrats or kings, you should be in good shape if you've done your research. So another passive income is REITs. A REIT is a real estate investment trust, which is another term for a company that owns and manages real estate. REITs have a special legal structure so that they pay little or no corporate income tax if they pass along most of their income to shareholders. Now, good thing is you can purchase REITs on the stock market just like any other company or dividend stock. You'll earn whatever the REIT pays out as a dividend yield, and as the best REITs have a record of increasing their dividends on an annual basis, so you could have a growing stream of dividends over time. Like dividend stocks, individual REITs can be more risky than owning an ETF consisting of dozens of REIT stocks. A fund provides immediate diversification though, and is usually a lot safer than buying individual stocks, and you'll still get a nice payout. The risk here is just like dividend stocks. You'll have to be able to pick the good REITs. That means you'll need to analyze, research each of the businesses that you might buy. It's a time-consuming process for sure. While it's a passive activity, you can lose a lot of money if you don't know what you're doing. So hence research is very important. REIT dividends are not protected from tough economic times either. If the REIT doesn't generate enough income, it'll likely have to cut its dividends or eliminate it entirely. So your passive income may get hit just when you want it most. So next one we can talk about is how to create a blog or YouTube channel. So if you're an expert on maybe travel to Asia, or a master of online games like League of Legends, or you're a really good chef at baking, take your passion for a subject and turn it into a blog or YouTube channel using ads and sponsors to generate your income. So you find a popular subject, even a small niche, and you become an expert on it. At first, you'll have to build out a suite of content and draw an audience, but it can create a steady income over time as you become known for your engaging content. So the good thing here is you can leverage a free platform, which YouTube, then use your great content to build a following. Then the more unique your voice or area of interest, the better for you to become the person to follow. Then draw sponsors to you. But the risk here is you'll have to build out content at the start and then create ongoing content. And you'll need to be really passionate about the product, since that can help you maintain the motivation to continue, especially at the start as your followers are still finding you, basically. And the real downside here is that you can outlay a bunch of your time and resources with little to show for it. If there's limited interest in your subject or niche, your area of expertise may be too niche to really draw a profitable audience, but you won't be sure of that until you experiment. You always got to try. The next passive one is rental income. So investing in real estate properties is a really good way to earn passive income, but it often requires more work than people expect. If you don't take the time to learn how to make it a profitable venture, you could lose your investment and then some. Just make sure you do some research, just like with dividend stocks, on the housing market in the area you're looking to purchase at, and learn about rental incomes. The good thing here is that to earn passive income from rental properties, you must determine three things. Okay, how much return you want on the investment, the property's total costs and expenses, and the financial risk of owning the property. So once you figure that out, so like for example, if your goal is to earn $10,000 a year in rental income, and the property has a monthly mortgage of $2,000 and costs another $300 a month for taxes and other expenses, you'd have to charge like $3,133 a month to rent to reach your goal. Risk is there are a few questions to consider. Is there a market for your property? What if you get a tenant who pays late or damages the property? What if you're unable to rent out your property? Any of these factors could put a big dent in your passive income. And the pandemic has posed new challenges, really. Due to the economic downturn, you may suddenly have tenants who can no longer pay their rent, while you may still have a mortgage of your own to pay. Or you may not be able to rent the home out for as much as you could before as incomes decline. So you'll want to weigh these risks and have a plan B basically in place to protect yourself. So the last idea is a peer-to-peer lending. So peer-to-peer lending is a personal loan made between you and a borrower, facilitated through like a third party, such as Prosper or Lending Club. Other players include Funding Circle, which targets businesses and has higher borrowing limits, and Payoff, which targets better credit risk. But opportunity here is, as a lender, you earn income with interest payments made on the loans. But because the loan is unsecured, you face the risk of them defaulting, meaning you could end up with nothing. To cut that risk, you could do two things: diversify your lending portfolio by investing small amounts over multiple loans. So at prosper.com and Lending Club, the minimum investment per loan is $25. You analyze historical data on prospective borrowers to make informed picks. So the risk here, of course, is it takes time to master the metrics of peer-to-peer lending. So it's not entirely passive, and you'll want to carefully vet your prospective borrowers. And because you're investing in multiple loans, you must pay really close attention to payments received. Whatever you make in interest should be reinvested if you want to build income. So economic recessions can also make high-yielding personal loans more likely a candidate for default too. So if the pandemic continues, these loans may go bad at higher than historical rates. How many streams of income should you have now? There's no really one-size-fits-all advice when it comes to generating income streams. How many sources of income you should depend on where you are financially and what your financial goals are for the future. But having at least a few is a good start. In most cases, you'll basically catch more fish with multiple lines in the water. In addition to the earned income generated from your human capital, rental properties, income-producing securities, and business ventures are a great way to really diversify your income stream. Of course, you want to make sure that putting an effort into a new passive income stream isn't going to cause you to lose focus on your other streams. So you do want to balance your efforts and make sure you're choosing the best opportunities for your time. Minimize your taxes on passive income. This is very important. So a passive income can be a great strategy for generating side income, but you also want to generate a tax liability for your effort. But you can reduce the tax and prepare for your future by setting yourself up as a business and creating a retirement account. This strategy won't work for all of these passive income strategies. However, and you have to be a legitimate business to qualify. You got to register with the IRS and receive a tax identification number for your business. Then contact a broker who can open a self-employment retirement account such as Charles Schwab or Fidelity. Determine which kind of retirement account might work best for your needs. Two of the most popular options are the solo 401k and the SEP IRA. If you stash the cash in a traditional 401k or SEP IRA, you can take a tax break on this year's taxes. The solo 401k is great because you can stash up to 100% of your earnings into the account up to the annual maximum. Meanwhile, the SEP IRA, to contribute, you're only allowed at 25% rate. So I hope you guys enjoyed the video and found it helpful. If you did, please subscribe, like the video, and hit the notification bell if you want to see more content on personal finance. I hope this gives you guys an idea of what you can do to increase your income streams and just how to make money work for you. Remember, consistency is key. Hard work pays off. Thanks, guys. I'm Michael, and I'll see you guys in the next video.